Unsurprisingly, the business cycle influences the rotation of stock market sectors and industry groups. Certain sectors perform better than others during specific phases of the business cycle. Knowing the stage of the business cycle can help investors position themselves in the right sectors and avoid the wrong ones. The graph above shows the economic cycle in blue, the stock market cycle in orange, and the best performing sectors at the top. The blue economic cycle corresponds to the business cycle shown above. The center line marks the contraction-expansion threshold for the economy. Notice how the orange market cycle leads the business cycle. The market turns up and crosses the center line before the economic cycle turns. Similarly, the market turns down and crosses below the centerline ahead of the economic cycle. The technology sector is the first to turn up in anticipation of a bottom in the economy. Consumer discretionary stocks are not far behind. These two groups are the big leaders at the beginning of a bull run in the stock market. The top of the market cycle is marked by relative strength in materials and energy. These sectors benefit from a rise in commodity prices and a rise in demand from an expanding economy. The tipping point for the market comes when leadership shifts from energy to consumer staples. This is a sign that commodity prices are starting to hurt the economy. The market peak and downturn are followed by a contraction in the economy. At this stage, the Fed starts to lower interest rates and the yield curve steepens. Falling interest rates benefit debt-laden utilities and business at banks. The steepening yield curve also improves profitability at banks and encourages lending. Low interest rates and easy money eventually lead to a market bottom and the cycle repeats itself. The chart on the screen shows relative performance for the, at that time, 9 sector SPDRs near the 2007 peak and after the 2003 bottom. The S&P 500 peaked from July to October 2007 and broke down in the fourth quarter of that year. In the summer of 2007, the energy and materials sectors were leading the market and showing relative strength. Also, notice that the consumer discretionary was lagging the S&P 500. This sector action matches what is expected at a market top. The S&P 500 bottomed in March 2003 and began a powerful bull run that lasted until the peak in the summer of 2007. The consumer discretionary and technology sectors led the first move off the March 2003 low. These two showed relative strength that affirmed the importance of the 2003 bottom.